What's up everybody, welcome to my channel where we don't do and think like the average person out there. So in this video today we're going to be talking about how you can invest your money without actually investing in the stock market. Like, you don't have to go out there and pick individual stocks to see a return on your money. Now, there's this common misconception out there that you need a whole lot of money to start investing, but this is far from the truth. You don't need a lot of money to start. If you're going to go the route of individual stocks, you just need as little as 50, like even less than $50 to buy like an individual stocks. However, the amount you need to fund your account will vary from broker to broker, but we're not going to be really talking about stocks in this video. Now, instead of having your money sitting there in a savings account, gathering dust and getting beaten up by inflation, well, the little money they give you on a savings account can't even buy like a patty nowadays. Much for a patty like $300 or more, it can't do anything. So if you don't want to pick individual stocks, you're risk averse, then guess what you can do? You can go out and invest in what is called a unit trust. So the unit trust is pretty much a fund where the professionals group up all your money as investors and they invest it in a well-diversified portfolio. So these funds are pretty much invested in these three asset classes: stocks, bonds, real estate. So like the name stock suggested, a stock fund will give you exposure to the stock market without you having to go out there and invest in stocks. Likewise, the bond and the real estate fund. So you also have like a fourth category. It's not like a type, like an asset class, but you have one that normally gives you global exposure. So it can be stocks, bonds, and real estate as well. So it would be like, if you want some exposure to the international market from a local standpoint, then you can invest in a globally diversified unit trust. Now, an example of this would be like the JMB Gilted USD Money Market Fund, where it is invested across sovereign bonds, corporate bonds, and preference shares, where it is diversified across the Caribbean, Europe, America, and Canada. So that is a well-diversified fund. Now, it is important to note that unlike stocks, you can buy a unit trust directly from the stock exchange. You have to do this through your broker. Have you ever realized that whenever you get a little interest in your savings account, you pay tax on it? Well, the advantage of some of these unit trusts is that they are tax-free, meaning that when you get the capital gains or when you sell or close out of these funds, you don't have to pay any taxes on your capital gains. Now, I know the big question is going to be, Emar, how do I get started? Getting started is pretty much like you're going to invest in some stocks. You're going to need your KYC documents like your ID, your TR, and your proof of income, 2 references. And the thing is that as long as you have a source of income, you can invest in one of these unit trusts out there. So you don't have to be employed to like a corporate company to say you want to invest in a unit trust. As long as you can provide the relevant documents to open your account, then you can invest in a unit trust. So once your documents are out of the way, you're going to need some money to fund your account. And the minimum amount you need to fund your account starts from like $10,000 depending on which broker you go with. And these funds are well diversified. Like I mentioned before, you don't have to worry about selecting individual stocks or bonds. Now, depending on which broker you plan to go with, the fund name might be different, but essentially they are performing basically the same thing. So a bond fund is going to be invested in bond, but so for example, NCB Capital Markets, it's gonna be named something different. Barita, it's gonna name something different. Victoria Mutual, it's going to be named something different, but essentially they are under the same asset class. Sometimes these funds are also a combination of one or the other. So you might have a fund where it is combined with stocks and bonds and real estate. They also blend them like that, but essentially they are primarily made up of the 3 asset classes that I mentioned before. Whenever you're investing your money, it's good to know the level of risk that you're taking on. So whenever you go to one of these brokerage firms to open your account, make sure you know the level of risk that you're taking on in the fund. So for example, if you're going to be investing in an equity fund, that one might carry the most risk when compared to a bond fund. And the lower your risk, the lower your reward. And likewise, the higher the risk, the higher rewards. Another important thing you need to know is that these funds are managed by a professional, and like anything else, nothing in life is free. So more often than not, you have to pay some form of fee with the fund you are going with. Now, while past performance is not necessarily indicative of future results, it's always good to ask what were the historical results of the fund you're investing in like. So ideally, you'd want to invest in a fund that has a low management fee and has a good track record. So for example, if it was doing 10% for the last, say, 20 years, then maybe that would be a good investment for you. You might just start investing and then after that it start performing 5%, because like I mentioned before, past performance does not indicate future returns. Let's take a quick look at one of the popular unit trusts in Jamaica. And by the way, this is not an endorsement. I'm not a financial advisor, guys, so make sure you do your own due diligence. And me showing this is not a recommendation for you to go out and invest your money in this product. As usual, I'm just showing you what is out there. Here we have the Barita Growth Fund. Since inception has returned over 9,044%. That's a lot of returns. And the 5-year annual average as of January 31st is 17%. 3-year average, 10%. Like, that's a lot of compounding power right there. Now, when you start investing in any of these funds, you don't want to start investing and stuff. You don't want to say, you open the account with $10,000 and then the next month come, you don't put any in it. You want to ensure that you consistently feed these funds with as much as you can. If you can only put $100, if the broker allows that, then you put $100 and ensure that money is invested each and every month, right? Because you don't want to, when you reach 10 years down the line and you look upon where the value of this fund could have been, or the value of your portfolio could have been, you say, man, only if me did know and me wish me did continue. But you don't want to be in a place where you're wishing you have done this and you have done that. No. Once you start investing, you want to keep on doing it like your life dependent on it. Treat it like a grocery bill, something like that you can't do without. See how you can automate as much of this as possible. So you set it up and forget it. So it just automatically deducted from your salary. And if they have to set up like a standing order or whatever they have to do to have that money invested automatically for you, then let them do it. So in the description of this video, I'll be leaving a link to a video to the list of stockbrokers in Jamaica. So what you're going to do is just go on their website and then you check out the list of mutual funds they have. They may or may not have the performance of the fund. So some of them may have it up to a year, but for the historical performance, you might have to give them a phone call for that. So that's it for now, guys. Thank you for watching. And make sure you share this video with one friend who you think it will add value to.